Hi, everyone. Thank you for joining us for today's webcast, Gold Rally Over or Just Getting Started, a Technical Perspective, sponsored by Sprott Asset Management. Today's webcast will be providing one CFP, one CMA, and one CFAC credits. If you have any questions on credit, please don't hesitate to give us a call at 704-540-2657. We welcome any questions you may have at any point in time during today's webcast. You can type your questions in the Q&A box to the right of the slides, and we'll do our best to get to as many of your questions as possible. In the event your question is not answered during today's event, a member of the Sprott Asset Management team will get back to you directly. We've made materials available for you to download in the Documents folder at the bottom of your screen. As always, we appreciate your feedback and are striving to make these events the best they can be for your viewing satisfaction. At your convenience, please take a moment to take our survey that is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. In the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. So with that, I'd like to turn it over to today's first speaker, Edward Coyne, Senior Managing Director, Global Sales for Sprott Asset Management. Edward?
Thank you, Natalie, and thank you all for joining us today. At risk of repeating virtually every speaker this year, this has been certainly unprecedented and interesting times. And today we decided to take a more technical look at the gold trade and the gold allocation. I'd like to introduce Paul Wong, who is the CFA and market strategist at Sprott Asset Management. Paul Wong has more than 30 years of investment industry experience, specializing in investment analysis for natural resource investments. Paul first joined Sprott Asset Management in 2011, and from 2012 to 17, Paul was a senior portfolio manager responsible for Sprott positions of the Sprott hedge funds. From 2015 to 17, he was the lead portfolio manager of Sprott Precious Metals Equity Funds. Paul has experience in resource funds, asset allocation, quantitative funds, and was a proprietary trader for several years. Paul earned his Bachelor of Science in Geology from the University of Toronto and is a CFA charter holder. Again, my name is Ed Coyne. I'm the Senior Managing Director and host of today's call, and I oversee global sales for the firm. For those that aren't familiar with Sprott, Sprott is a global leader in precious metals investments. With over $17 billion in assets under management, Sprott is a publicly listed company and trades both on the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. What's unique about our firm is that we have a full suite of investment solutions. From our exchange-listed products that focus on physical bullion, as well as factor-based ETFs that look at both senior large-cap miners and junior small-cap miners, to managed equity solutions, both with our Sprott Gold Equity Fund with the ticker symbol SGDLX, which is an actively managed fund managed by John Hathaway and Doug Rowe, as well as our flagship mutual funds and equity funds and closed-end securities. In addition to both our physical products and our equity products, we also have unique solutions in the lending space, focusing on predominantly mid to smaller cap mining companies, as well as offer brokerage services in the precious metals markets. Today's webcast is really going to focus on the technical view of the gold market, talk a little bit about the economy, and look at ways you can leverage gold both from a physical standpoint and an equity standpoint to help diversify your portfolio. Paul Wong, our market strategist, is going to talk about COVID's unprecedented impact on the global economic landscape, the macro variables that explain gold's move. More importantly, look at the technical chart patterns for gold over time. Try to understand why gold may make sense over bonds and frankly over cash, and take a closer look at silver. I will wrap up the call with some Q&A and also give you a general look at our suite of products and how gold can diversify your portfolio. So with that, I'd like to start the call off with Paul Wong, our CFA and market strategist, start taking a more technical look at what's going on in the broader market. And the first chart really talks about, the financial conditions and what's going on from a deterioration standpoint. So, Paul, if you could spend some time on page 6 and really start the conversation on what this chart is telling you and what are some of the important takeaways from this chart.
Okay, sure. Thanks, Ed. Okay, first thing is the red line. That's the U.S. nominal GDP year over year. And what you'll notice that in the last 50 years, it's had a succession of lower lows, lower highs. Typically when economy gets in trouble, the Fed has a standard response. They lower rates and they inject liquidity or increase debt. But what you'll notice is that every cycle you need more and more debt to basically get the same effect you had in the prior cycle. And every cycle ends up with higher levels of debt than the prior cycle. And that's the black line, which is the Fed is debt as a percentage of GDP. That's an inverted chart, so you can see every cycle it just gets higher and higher and higher. And I said they inject liquidity, so it shows up in money supply. That's the green line, and it's since COVID hit, it's been accelerating even before COVID, but since COVID it's gone exponential, and all that gets reflected in the price of gold in time. Switching to slide number 7, so that's our U.S. M2 money supply. I focus on the U.S. money supply because it's the data tends to be a lot fresher, and it's hard to track down a lot of the global measures. So this is a 50-year chart of the U.S. M2 supply. The black line on top, log chart, and the blue line is the 12-month rate of change on money supply, and I just mark some points. The point really is that the response to COVID is unprecedented. It's more than twice the growth you saw back for the Great Financial Crisis back in 2008 and 9, which is around 10%. Today we're really realizing around 23% growth rate. And the reason being is that COVID was just a synchronized global demand shock. It happened simultaneously. And so the response has been quite extraordinary. Globally, there's been almost $8 trillion of monetary policy added, to 13 trillion fiscal. Well, the problem you had is that at the zero bound, conventional monetary policy essentially stops working or stops working well. And you need to achieve the next level stimulus to create the kind of economic growth. And what we're seeing now is that almost all the countries are they're essentially moving towards MMT or MMT-like policy. In the meantime, you have the Fed announcing new policies. This is sort of the day-to-day tools they're using. September we had the outcome-based forward guidance and average inflation targeting. These are the new tools the Fed has added, to their arsenal. Talk about it a bit later, but the monetary response is what's driving the movement in price in gold.
Yeah, Paul, and I just to reiterate that, I think that's a very important part is. Point is that yes, COVID has certainly has an impact on the market this year, and it's had a shock factor, and it has really accelerated gold's move in the short term. But to your point, I think it's really more about the stimulus and what that's going to mean longer term for the gold trade. And I know we're going to go into those charts, but I thought that was a point that was worth reiterating, that it's really the response to COVID that's really driving the demand for gold longer term.
Right. It's again, that word again, unprecedented. But the thing is that it's not the end. I mean, if it was the end, then every central bank would say right now that the crisis is over, the economy is returning back to normal. We don't need any more stimulus. In fact, the opposite is saying that. I mean, every Fed speech you've heard since COVID is basically. They keep emphasizing the need for more and more stimulus.
Right. Well, let's go to page 8 and talk exactly about that. The QE alone resulting in money printing. Let's highlight that a bit, because I think this is a great chart to start to reiterate what's really happening in the market and what the balance sheets and money supply really mean to the overall economy.
Okay, sure. Okay, so the black line is that's the Fed balance sheet or the result of QE. Currently, right now, it's sitting around $7 trillion. We've had a big movement from COVID. Went from about, roughly about 3.5 to 7, so a doubling, fastest rate ever. The purple line is the excess reserves. So the problem you have with QE is that it needs to go through the financial system, and when it goes through the financial system, a lot of it gets stuck in the system. Because typically, banks, they aren't reserve constrained, so that, the excess reserve gets stuck in the system. And so what you'll see is the green line. That's the velocity of M2, or the multiplier effect. Basic collapses. It's been steady, heading lower and lower through time, and since COVID, it's absolute collapse. So what it's really saying is that the Fed is launching a lot of stimulus, but also a lot of that is also stuck in the balance sheet, stuck in the reserves in the financial system, and it's not making its way into the real economy. And because it's stuck in the financial system, you can see the effect. It's on stock markets, on real estate. Like, that's one part, where it is working. And it explains the K recovery. It's a good part. It explains the growing equities in the economy. But the bottom line is that at the zero bound, it's just not working, and they're going to have to probably make some changes to this. And again, it's changes are likely to be positive for gold.
Well, and
slide
Paul,
number 9.
This really brings up what does this really mean for gold then? This is really what brings us to the crux of today's call, is what does this, how does this translate to the gold trade, to the gold allocation?
Right. So if you think gold is a store of value, i.e., it's money, then that's slide 9. So the black line is the U.S. dollar gold cross. So the way to read is $1 buys currently right now 0.00053 ounces of gold. And back in 1970, before the U.S. went off the gold standard, you think you bought like 0.028 ounces of gold. But it's really it just reflected the expansion in M2, the green line. Again, that's another inverted chart. And just for clarity, fiat money, all it means is it's money that's it's not backed by anything of value like a commodity. Basic governments control the amount of money that's issued and flowing in the system. Since COVID hit, pretty much every developed country economy on the planet has expanded the money supply tremendously. U.S., Europe, China, Japan, everyone. And that's happened. It's probably going to keep happening. So what does it mean for gold? If you look at the long-term correlation, gold has roughly about an 80% R squared to M2 over the last 50 years. And since the great financial crisis, since we hit the zero bound limit, if you take M2 and other important factors like currency, yields, credit, that R squared goes up to about 88%. And if you take the last 5 years, that number actually goes up to around, last time I checked, it was around 95%. So you can see the gold is really starting to track these variables, and the variables really do explain what's going on in gold right now. Taking it back a little bit more, so what does that mean for gold? If you apply rough math, and I think I used just a basic regression fit. So since the great financial crisis, roughly every $1 trillion in debt, about 2/3 it ends up as in M2. So basically, you get roughly about a $666 billion increase in M2. And if you regression fit that back, again, these are very rough numbers, but that works out to about $120 an ounce in gold. And if you go back to the prior chart, M2, the growth rate roughly about 7%. Apply that to current M2 levels, and you're looking roughly about $200 or more per ounce per year if you assume M2 grows at the historical long-term rate. And chances are I'm willing to bet it'll be much, much, much higher than that.
And Paul, let's touch on that for a minute. Yeah, sure. I was going to say let's touch on that, the long-term the long-term patterns of gold, because I think a lot of investors, the investor circle is starting to expand on those that are interested in the gold allocation today. But this is nothing new. And let's talk about gold bullion from a technical standpoint, longer term. So we know what's happening shorter term, but I know on page 10 you address kind of longer term, what does this mean, and what could this do to the overall gold price longer term? Can you, I know you're getting ready to finish on another point as well, but can you touch on that as well to walk people through the longer term outlook for this allocation?
Okay, sure. So this is a long-term secular chart log, and the black line is that's a secular channel. Gold's been riding since about the mid-70s. The hard, figure out where do you start the chart. I started right after the Bretton Woods system collapses, pretty much by March of '73, and basically, gold gets re-rated because every currency is now starting to be devalued. So it reached a high of $200, pulled back to $100, and that's where I marked the beginning of the secular channel. So it's been riding inside this channel for almost 50 years. You'll see that it tends to have sharp moves up, sideways consolidation, sharp moves up. And so this latest move, so the peak in 2011 to the breakout in August of this year, to me that's a very clear cup and handle pattern. And breaking through the $1,900 level, you triggered a cup and handle breakout. You can do standard projection targets on this, but basically the basic minimum target you get is roughly about 2750 gold on a just a pure cup and handle projection target. Okay, switching to slide 11. So medium-term chart. One thing you'll notice about gold is that in the last cycle, it literally, on a long-term basis, it looks like it has a pretty straight line up. You look at it a little closer, what you'll see is that gold trades in what I call channel projections. So basically, it runs through channel, consolidates, and it hits the next higher channel level. And you can layer that in with some Fibonacci retracement patterns, and you get a pretty good, you can get a pretty good estimate as to where gold will trade. I guess the hard part for most people is that these moves tend to be very gappy. That's the nature of gold; it tends to be gappy. That red line on the chart, the 375 level, that's a big base breakout pattern on gold. Typically, when you get one of these types of patterns, you tend to get a movement that's very very dramatic. It's I have to think of like a coiled spring type move. But what you'll see is that gold will have very very sharp gapping up moves. It'll pull back and then consolidate a little bit and then pop higher. Again, you can see on the far left what the progression looked like in the prior cycle. That's not the complete move in gold, but that's typically what you'll see, and that makes trading in gold difficult because typically in the last cycle, what I remember every general I was speaking to was literally saying, "Yeah, I'll buy gold when it pulls back. I'll buy gold when it pulls back." And the problem I had is that it actually never really pulled back materially enough for them to buy. And if we switch to page slide 12, that's a short-term pattern, and this pattern is exactly what you saw back from 2001 to 2011. You get these. I marked in the circles these consolidation patterns. Typically it's there's typically two types: flatter-looking one and one that are a little bit more sharper down. And typically after you get one of these, it consolidates. Intraday, you get these very sharp moves that scares people. And psychology is always like what's going on is at the end is the end, and then it pops higher, and people think, I missed the move. Can't buy it, it's too high. It pulls, but you know what I mean. So literally, this is how gold trades, and it's traded like that from 2001, 2011, and the pattern seems to be repeating again. So if I can offer one advice, is basically just follow the follow monetary policy, fiscal, M2, dollar yields, and stick with the long-term trend questions.
And Paul, I think that's a great point because so often people get caught up in the short-term noise of all investments, not just gold, but in particular with gold. When you look at this chart on page 12, you can understand why people tend to either A, lose patience or get scared out of or let fear dictate the way they allocate or invest in gold. And I think for our listeners today, that distinction between trading gold and investing gold is an important one because longer term, an investment in gold has continued to serve well in a portfolio, where trading, if you get it wrong, it's a great way to create a lot of frustration in your portfolio. So I think this is a great chart for people to sort of zero in on and think about when they're considering an allocation to gold, is to have a longer term view on why you own it and how to own it. So I think this was a great chart to address that. So thank you for that. What I'd like to do, Paul, is sorry, go ahead.
Sorry. Yeah, there's one thing about gold is of all the asset classes out there, it tends to be very emotional, and also a lot of most fund managers I worked with always had a hard time trying to understand gold. They don't understand it, so they get caught in the day-to-day trading action. So it happens. It's common. It happens quite a lot. If there's one indicator that's starting to really help a lot, it's on Bloomberg, but there's a function that tracks the total amount of known gold held in ETFs. I wrote a bit about it in the September commentary, but it's a good thing to track. It gives you a better picture as to what longer term money is doing with gold. And yesterday it made a new all-time high. But that's a good one to track, because it is reflective more of long-term, more patient, less trading type money.
Well, I think to that point, I can just speak from a sales standpoint, we are seeing that investors' interest in Circle expand from an unsolicited standpoint. We're getting more and more inbound calls and interest on how to think about the allocation, how to allocate to the space itself, and so forth. So I think we expect that to continue based off the call volume and activity we've been seeing really the last couple of years, but it's really spiked this year in particular to really bring it to light. Paul, I know we spent a lot of time talking about kind of what's caused sort of the shock in the system. We've talked a bit about the value of a core allocation to physical gold. Sort of the natural progression, I think, for this call is gold equities. How should someone think about gold equities? Are they an allocation that's just too volatile to think about, or is that something we should look at? And I know on page 13, you start to address the story behind gold equities. So if you don't mind shifting gears and talking about that for a bit, I think that would be beneficial for the group.
Okay, sure. So gold equities are more volatile. Historically, it has about twice the volatility of bullion. But let's go through some of the technicals. So black line is the GDM, or the NYC ARCA Gold Miners Index. Dash line indicates the channel has been sitting in going back since the early 90s. Red line is the big trend, is the big breakout pattern. Similar, if you want to equate it back to gold bullion, this would be the rough equivalent of the 1375 breakout level. So on a chart-to-chart basis, you can see like bullion is is much further ahead than equities. But you can see the patterns for the most part are very similar, but it's just essentially it's been delayed. But it also follows, again, if you look at the last cycle from 2000 to 2011, it goes through the same process. There's a strong impulsive move up. It goes into a chopping consolidation, and it shoots higher again. Again, big moves, very volatile, and again, it tends to be difficult for most people to try and trade. So again, you have to have a view of where you think gold is going. On slide 14, I put two charts. So basically, this is the gold miners. The top one is the gold miners to bullion ratio, and what you'll see is that you can see it's breaking out of this down channel that's been in place since about the mid 2000s. Marked the big overhead resistance level, and you can see the green. It's shaping up this bullish pattern. Now, this is important because what it'll mean is that, once this breaks higher and up, you get a relative flow of money from bullion to equities. Same thing with the chart below. This is the gold miners to S&P ratio. Again, the red line, big overhead resistance level. And again, once the turn starts to happen, you get a relative flow of money into gold miners. And it's very important because it's one thing about gold equities. It's the limited market cap. So when I ran my first gold fund back in the mid '90s, one of the first things I found out was that if you add up the market cap of every single North American traded equity, it was less than Coca-Cola. But that means that when the flow of funds turn towards gold equities, it really turns, because you go from pretty much no buying to full incremental buying, and it has a big implication on to where gold equities go. Basically, it's the big gap. Today, same thing. So if you add up the market cap of every North American traded gold equities, I think it's roughly about the size of Procter & Gamble. But right now, only 10 stocks has a market cap north of 10 billion. So when the flow turns, and again, this market is it is ideally shaped for this type of crowding effect that we've been seeing in a lot of different sectors. It hasn't happened yet. Will it happen? I'm not certain, but if it does, it'll be very quick and sudden. And we've seen it every single cycle. And what you'll see is prices will start to gap up, pullbacks become shallower, volatility starts to collapse, and it starts to really outperform. Again, it's a limited flow.
Paul, to that point, do you think the last 10 years or so, with more and more ETFs and indexing out there, more quant funds, more technically driven type of investment strategies, hedge funds, and so forth, I know this is pure speculation, but do you think as that market's become more mature and more capital has found its way into those types of investment strategies, this kind of, quote, crowding effect, that if it does break above that red line, whether it's the S&P ratio or the gold bullion ratio, again, speculation, but that severity could be really extreme, given there's so many more quantitative kind of electronic-driven trading platforms that are effectively momentum type of processes out there. How do you think that's going to affect this type of move in the market?
Well, it's the bottom line is that it's most strategies are momentum based. They tend to have a liquidity cutoff. But so you're in this I guess this race as liquidity gets higher and higher, and as the thought that gold stays higher for longer, then eventually you get the turn. And I mentioned it's the relative lack of liquidity. So when the turn does happen, it'll happen very quickly, and it'll just take off like a rocket. I've seen it before numerous times in the past. But once the dynamic flows take control, it takes control. Gold equities will move, and it forces this self-feeding crowding effect. We've seen it in other parts of the market. This year, technology being probably the most extreme ever. But it's the same notional idea. But if you apply that to gold equities, it will happen. There's just not enough liquidity flow to satisfy all buyers.
And let's talk about that for a moment, because I think the general view on gold equities is that they're nothing more than a levered trade or levered allocation to the directional price of physical gold. But gold equities, personalities, and balance sheets have certainly changed in the last decade or so. I mean, you've got storied investors like Buffett buying large cap mining companies like Barrick Gold, because they could have gone to physical, but they chose equities. And valuations are changing, free cash flow is changing, margin expansion's happening. Talk about gold equities for a moment as a true stock with a real balance sheet and so forth, and more than just a levered trade to the price of gold. And I know you start to address that a bit on page 15. So if you don't mind, spend some time on that, because I think it's important for our listeners to understand that these are also stocks that also have earnings, that also have balance sheets. And yes, it's an investment relative to the price of physical gold, but it's much more than that as well. And if you could spend some time on that, I think that would be beneficial for everybody today.
Okay, sure. I guess so gold equities in the last cycle was really driven by growth at any cost. And, you know, typically when that happens, yeah, it doesn't end well. But as usual, the pendulum swings, and so this cycle, it's radically different. You mentioned balance sheet. The last cycle, very leveraged balance sheet. Today, pretty much most companies are not carrying any debt. They're completely almost unleveraged. The return on capital last cycle was not a thought. Today, every management company talks about return on capital, and they reach levels where, and they run the business so there's a sustainable return on capital, and as gold prices head higher, that return will head higher. There's a focus on free cash flow. This cycle, free cash flow levels are high, and probably heading higher as gold prices get better. Past cycle, there was very little thought given to free cash flow. If you generate free cash flow, then you generate free cash flow, but no one made a big deal out of it. M&A in the last cycle, again, because growth at any cost, it was a little crazy. Today, M&A is very measured. It's very much more disciplined. But probably the biggest thing for the companies is the cost structure in industry in the last cycle. So in the last cycle, we had the big China boom. So there was big capex plans into iron ore, met coal, copper mines, and so all that mining equipment went up in cost, double, tripled. Mining engineers double, tripled. Cost of anything and everything went insane the last cycle. This cycle around, completely different. You're in almost a deflationary type of environment. Oil prices peaked out at 120 in 2008. Today we're sub 40. Unemployment it's a problem across the world. So you're not going to get a lot of labor pressures on gold companies. So, your two biggest cost component gold mines is power and labor. All the other incidentals are coming down as well. So pendulum is swung now back the other way. You have management teams that are focused on return on capital, cost structures are well in place, clean balance sheets, focus on return on capital and capital discipline. Very, very different. And if you go to slide 15, you can see that the blue line is the gold miners index. This is the estimated EV/EBITDA. And one thing to point out is that for the miners, for the most part, they're still trading in the bear market ranges. So the market peaked out in 2011, and since then you're trading in that low range. You're basically trading with bear market valuation bands on an industry that's basically found religion, and it's now gone the other way. And I just highlighted the information technology group. EBITDA, it's more than twice. But the thing to point out is that since the Powell pivot, markets have really been driven by lower real rates and a weaker U.S. dollar. For technology, that means higher multiple expansion. For gold, it means store value. But the R square between the GDX and the XLK, which is the tech ETF, it's sitting at 81%. And of all I checked a number of ETFs, just the big liquid ones, but it's by far away the highest correlation. So basically, you think about gold equities. It really is on a macro level basis driven by the same underlying macro factors, except that it's less than half the valuation, and all the price increases have been driven by earnings. There's very little multiple expansion there. At most 20% from PE expansion, maybe. That's it. Whereas technology, it's completely driven by multiple expansion. And I showed that on slide 16. So since 2018, earnings outlook has been flat. All movement we've seen is multiple expansion. Gold miners, that black line, it's, I don't know if it's sustainable, but that earnings growth rate is running at roughly about 80% growth rate right now. And yeah, it's I think the closest analog probably in terms of earnings power in a gold company is probably back to the 30s, where you had gold was held flat, but your cost components were crushed into a big deflationary cycle, and so the margins kept expanding through the 30s. Today, I don't have the numbers from the 30s, but I don't, like in the 30 years I've been doing this, I don't recall a time where gold companies have this type of structural advantage in terms of ability to grow margins, positive push on the revenue side, and downward push on the cost side. Just haven't seen that before. And right now, no one really cares. You can see there's just not a lot of inflow to gold equities. It's a lot of people are ignoring it. And to me, it's probably one of the best value plays out there. I mean, the whole market's been fixated on this. When will this rotation happen? Out of growth into value? Because in the growth side, there's 5 stocks that make up 24% of the S&P 500. Concentration levels are as high as it's ever been, and every time we've seen high concentrations in broad equity markets, it's always ended badly. Whether it's oil in the late 70s, technology in 2000, it all ended badly because the crowding effect is it's dangerous. You have to keep justifying ever higher and higher multiple with very little growth. So if you have one area in value, again, I'm not a value expert, but to me, it's you have one area in value where the same macro forces are driving tech, it's driving gold, and I just put that out there. But it is very different. I don't recall ever seeing something like this.
Well, and let's shift back real quick to gold, because I think that ultimately is where the story starts, right? So you can't have margin expansion necessarily if the price of gold's going down. And, as we talked about the last 4 decades, it's been this slow march north with these periods of extreme moves when there's been, volatility introduced into the market or decoupling in some part of the market, whether it's, economy related or terrorist related, or whatever the case may be, where there's a decoupling or dislocation in the market. Gold continues to march forward. So, let's go back to gold for a moment from a portfolio holding standpoint and what that looks like relative to U.S. Treasuries, what that looks like to the U.S. Treasury index ratio, and so forth. Talk about that just for a moment before we wrap up the more formal part of the call today.
Sure. All right, so on slide 17, I have a chart, top panel, U.S. Treasury Index and bullion. The blue panel below is the ratio of bullion to the U.S. Treasury ratio index. Red line marks, again, a big breakout pattern. Gold has outperforming since December 2015. It's outperformed by about 50% or annualized about 8.5% probably on a compound basis. I guess the thing about gold and treasuries is that they both provide diversification. The bonds you have a problem with is that you're at the zero bound, so you don't really have much more in terms of upside. I guess you're protected on the downside. But gold, you have diversification, plus you don't have any cap on the upside. Gold moves with M2, and pretty much there's virtually no cap on the upside. Another thing about bonds is that at this price level, it's kind of odd now, but this is the way it is. You're buying bonds for capital appreciation because there's no yield on it. Lower the curve you go. So you think of it that way, then it becomes very difficult to hedge a portfolio with bonds by itself. I mean, I think the negative correlation periods we saw from the end of the great financial crisis up to about probably January, February this year, that deep negative correlation is probably gone. Like it doesn't. You're at the zero bound. You're going to have zero correlation. So you lost a big portion of your downside protection in a multi-asset portfolio, and many fund managers are starting to replace it. And that's where gold comes in, because it does have unique features. I mean, I heard fund managers trying to replace bonds with high-yielding equities. Okay, that makes some sense, but at the end of the day, they're still equity, and they're going to have an equity volatility. And it's not going to give you the kind of diversification or non-correlation you need. And going back to the blue line chart, yeah, that's a breakout chart. That chart's heading higher. It's gold will continue to outperform bonds for the next while.
Well, and that brings up a good point too. I mean, historically, as an investor looked at gold, they looked at it predominantly to hedge their traditional equity portfolios. But to your point, lower for longer interest rates, real rates flat to negative in many parts of the world. Gold is starting to serve as a replacement in many cases to bonds, and even from a cash standpoint, particularly international investors, they're looking at gold now as a addition to or complement to even their cash positions in their portfolio. So the physical gold allocation is serving multiple roles right now in a traditional 60-40 portfolio. So I mentioned this before, but we are seeing an investor circle start to expand. And I think, Paul, to your point about this sort of zero-bound limited upside to bonds, an investment into physical bullion makes a lot of sense as a core allocation. And then for those that want some additional torque to the allocation, the gold equity story today looks more interesting than ever, given all the things you mentioned from a free cash flow and margin expansion and better balance sheet standpoint. I know the title has the word gold in it. It does not have the word silver in it, but I've started to learn more about our audience, and invariably people will start asking questions about silver. We currently have 59 questions, for example, in the queue, and as I was scanning through them, there was a lot of questions on silver. So we sort of wanted to get ahead of that, as it were, and on page 18, I'm going to ask you to really focus a little bit on silver and what that means for a portfolio today, and what's your view on it. I know you focus predominantly on gold, but talk a little bit about silver. How should investors think about that?
Okay, sure. Okay, so let's talk a bit about the chart first, and then we'll get a little bit some of the nuance. Okay, so I overlaid the gold and silver together on the same chart, and the prior peak in silver back in 2011. If you want to call it a blow off, top bubble, whatever you want to call it. Okay, let's I'm being conservative here. So if you do that, then with gold trading roughly around 1900, if you rough fit it, the silver should be trading around the $30 to $35 area. That's roughly where it should be, and it's not. It's lagging. So why is it lagging? If you break it down, what you'll see is it's the flow into ETFs. So there's another function on Bloomberg as well. I think the ticker is ETSI, TOTL. It tracks the total known amount of silver in ETFs. Gold started off first because it's bigger, it's liquid. It has like roughly 15 times the liquidity of silver. You saw the migration in large funds into gold, and we've been seeing it steadily since about just around the time of the Powell pivot in 2018. Silver just started moving more recently, and gold-silver ratio has been coming down in favor of silver. Now, what really drives silver? It's kind of interesting. So if you take the gold-silver ratio and compare it to there's a Morgan Stanley cyclical index. If you take the cyclical divided by defensive index, so basically it measures whether cyclicals are outperforming or not. The gold-silver ratio has a 71% correlation to that, meaning that silver performs really well when the market has a pro-cyclical bent to it, as it does now. And it does, and if you overlay that with when gold is bullish, it's typically, that's the calling card for silver. So you have two markers, bullish gold, check, and a rotation towards cyclical from defensive, and that's what we're seeing now. the whole exercise of the Fed is basically trying to, get a cyclical recovery going. You can see a lot of we have a lot of V-shaped recoveries in a lot of different parts of the market. And you can see there's a rotation towards that. But for silver, what it means is that it has this really unique feature. One, it has a store of value feature like bullion. So long term, it still has a very strong correlation to M2. But it also has a strong correlation to pro-cyclical factors. So it's a very odd, very rare hybrid asset. But it is volatile. Right now there's some little trading I mentioned in the September commentary. It looks like a lot of dealer gamma is in play. It will kick up volatility, but it will provide buying opportunities. So if you understand the trading dynamics and what's going on and how silver trades, then it does set up better buying opportunities. It's a higher volatility feature, twice the volatility but twice the reward. But it also offers a very unique feature. I don't know of any other commodity that has that store of value with a pro-cyclical bias to it. And silver, I think again it's lagging, but you'll see that if you pull up the amount of ounces held in silver ounces held in ETFs compared to gold, it's actually rising faster in gold. That clipped that level back in the summertime just before silver broke out this $18 range. You could see the accumulation happen prior to that. And since then, it's last little while has been a bit of a pause, but it's a blip on a bigger picture. So silver is probably the if you have a portfolio that can handle the volatility, it's very interesting to look at right now.
Thank you, Paul. That actually took care of about a third of our questions, which is great.
Yay.
But before we go into the questions, I do want to touch on a couple things that I think are of interest. One of them is really the long-term performance, as what I like to call the super cycle of gold, because so many people are really focusing on what's happened, frankly, in the last 12 months or so. But if you look at what gold's been able to do from a performance pattern standpoint for the last 2+ decades, on page 20, many investors are really surprised when they look at the overall returns of gold on page 20. So you have over 2 decades of return patterns, both up market cycles and down market cycles. And I think it's interesting for people to note that gold has been one of the best performing assets out there, over and above the S&P, over and above bonds, and cash, frankly, has been slightly negative. And the most recent cycle or current bull market cycle that, frankly, we saw begin in really the fourth quarter of 2015 when the Fed attempted to tighten. That cycle has really started to drive the current market move, and COVID really simply just expanded that in a much faster rate. But if you look at the last 4.5+ years, both gold and the S&P have delivered very similar returns, and both of them have obviously put a huge shadow over bonds, which are only up about 20+% over that time frame, and cash, which is again negative about 4% over the last 4.5+ years. So I think it's really interesting to think about gold not as a trade, but as a long-term core allocation. And given the current narrative we're seeing in the market, both from an economic standpoint and from a geopolitical standpoint, we think the narrative continues to be supportive for the gold allocation, which also we think translates into a gold equity allocation. And on page 21, I think it's important to note that not only has gold been an effective allocation to help dampen volatility, but it's also enhanced returns. So a relatively modest allocation of between 5 and 10% into a traditional 60-40 portfolio, you find that gold has been an enhancer of returns, but it also has been a reducer in volatility. So we're not here to say that you should sell everything and buy 100% gold. It's not an equation of gold versus the market, but it's really more an equation of gold and the market. And when you start to look at gold as a diversifier in a portfolio or a way to enhance a portfolio, I think when you go at gold with that lens, then it becomes a more effective, productive type of allocation. And on page 22, we like to talk a little bit about just really the different solutions Sprott has. With over 3 decades worth of experience, we are one of the largest, most focused firms in the precious metals market. And we do offer a full suite of solutions, whether you want to do a combination of gold and silver from a physical allocation in our Sprott Physical Gold and Silver Trust, which trades on the New York Stock Exchange under the ticker symbol CEF, or if you want to do a full pure play allocation into physical gold with the ticker symbol PHYS, or pure silver, PSLV. Those 3 specific trusts give you direct ownership of the physical metal, and for U.S. investors, they have a potential tax advantage as well, which we can certainly talk about offline. And then we even offer a platinum and palladium trust that gives you exposure to the physical metals. In addition to that, we do have 2 factor-based ETFs that give you exposure to the senior large cap, more established miners that have multiple mines and different phases of production, down to our junior small cap miners that are in many cases in late stage discovery or build out or early stage production. So we have 2 ETFs that are very interesting to look at as well that have a factor-based overlay that look at the underlying positions within that portfolio. And then we offer the seasoned portfolio that is an active portfolio managed by John Hathaway and Doug Rowe called the Sprott Gold Equity Fund, which we acquired earlier this year from Tocqueville. So we have an active approach to the equity solutions, and we have 2 factor-based ETF approaches to the solutions. And depending on where you are joining us today on this call within the country, I encourage you to reach out to our regional senior investment consultants. For those on the West Coast, you can reach out to Matt, the Midwest, the Central region, Julia, and for those on the East Coast, Sergio. So I encourage you to reach out to our senior investment consultants on page 23 and allow them to work with you on how to think about the allocation, how to think about the weighting in the allocation, and help us deliver to you some unique solutions on how to participate in both the physical market and the equity market. So with that, I'll take a pause and turn it back to Natalie to cover a few house cleaning issues before we go into some Q&A.
Great, and thank you both for such an informative presentation. As a reminder, a copy of today's presentation, as well as additional material, can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will get back to you directly. And if you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. So with that, I'll hand it back to Ed to take our first question.
Thank you, Natalie. As I mentioned, we knocked out a good chunk of questions when we addressed silver. I am looking at the inbox here at 71 questions currently. So I will tell you this, we'll probably only have time for a few questions live, but between Matt, Sergio, and Julia, we will make every effort to respond to everyone's questions in the next couple of business days, depending on how you registered, either by phone call and or email. So rest assured, we will get back to everyone with questions, and we'd be happy and would welcome the opportunity to have a more detailed call with everyone today, frankly, on how to think about the allocation. But with that, I'd like to start with one of the questions that I think is one that's on a lot of people's minds, which is how important is the devaluation of the U.S. dollar to the bullishness of the gold trade? And Paul, I think that's a good question for you to address, because that seems to be what's happening a lot today is there's an inverse correlation to the strength or weakness of the U.S. dollar. So how important is that longer term when thinking about gold?
Well, it's important, but you need to put it within context. So a weaker U.S. dollar, you should see that consistent with the outlook for monetary policy, real interest rates, credit conditions. It's part and parcel of all the other variables that are going on for gold. You can short term, sure. I mean, the market can trade day to day with fluctuations in gold and in the dollar pricing and impact gold that way. But longer term, what you should see is a weaker U.S. dollar consistent with expansionary monetary policy, higher fiscal policy expected, real rates still in a negative and into still a downtrend. You should hear the Fed continue to talk about loosening money, financial conditions, and a bunch of other indicators. But it's important, but you should really look at it in conjunction with the other indicators to get a much clearer, consistent view on the direction of gold.
Great, thank you.
And by the way, they want a weaker U.S. dollar, period. That's
right.
A strong U.S. dollar tightens financial conditions around the world like you wouldn't believe. The biggest short on the planet right now is a U.S. dollar short. So a decade ago, there's discrepancy in some of the numbers. The most conservative number I've seen is there's roughly about a $13 trillion short in the U.S. dollar, meaning that foreign countries issue debt in U.S. pay denominated in U.S. dollar. So back in March in 2020, the reason why the Fed opened up all the swap lines was try and get U.S. dollars flowing in the world. One of the big pressure points in the overall market was again, the squeeze on the U.S. dollar. If you see a move up in the U.S. dollar, I'm pretty certain the Fed will find a way to knock that thing back down again. You cannot have a stronger U.S. dollar, and again, it's part of the the Fed put, as I mentioned.
Here, thank you for that one, Paul. Here's another one that I think is one that's probably on a lot of people's minds. This relates to interest rates. We've all talked about lower for longer interest rates, whether we're talking about the Fed fund rate or real rates. But the question is, what's the history of gold and gold mining stocks during a rising interest rate environment? What's been your experience on that, Paul? If you can speak to that.
Well, it's variable through time. The most consistent one is real interest rates. So in the 70s, we actually had rising interest rates, but gold ripped through it because the real rates were collapsing because inflation was so high. It depends is the answer, but the real answer is look at real rates. Don't look at nominal rates. Right now, nominal rates are held flat. The Fed is has a $120 a month QE program. Nominal rates aren't reacting. Look at where real rates are going. If you want, you look at break evens. Look at break evens where they're heading. Basically, is break evens head higher. So if we get this reflationary push to the market, break evens will head higher. We'll expect the Fed to keep nominal rates within a band, and that means real rates will collapse, head lower.
And
I know don't get too fixated on where nominal rates are going. It may create day-to-day trading noise, but the real picture is real rates.
All about the real rates. Perfect.
Yes.
And I know we're coming up on the hour, and we can certainly address one or two more questions. And as I mentioned, we will get back to everybody by phone and or email. But just looking at the questions, trying to consolidate them here. Another question is always obviously price targets, and I know you don't want to get pinned to a particular price. The questions range from as much as, can you justify a $4,000 per ounce price target? Another question that came in was specific to a little more modest, which is what is a realistic 2021 outlook or upside for gold? Can you talk about that for a moment? I know you addressed it a bit in the presentation, talking about the 2,400 range or so based off money supply. But what do you think the price target could look like? Let's say now through the end of next year, just to get a sense of what people can think about.
Yeah. Okay. So if you use a combination of technical and model inputs, like macro model inputs, within a certain band, it works out. I just did that like last week. It's somewhere around, call it 2,150 to 2,500. Well, the problem you have is that there's so much uncertainty, right? I mean, I could paint a picture where, let's say, the Democrats sweep, all of a sudden you get a $2 to $3 trillion stimulus package rolled out right away, and again, back to math, that's $200 to $300 rough increase in the price of gold pretty quickly. And if they decide that, okay, yeah, we're going to, the Fed keeps the swap line, U.S. dollar swap lines going past March, then yeah, you're going to have a weaker U.S. dollar. If you keep the nominal rates capped, you get a break-evens reflecting the stimulus, then real rates are going to plunge even more. Then yeah, you get your $2,500 price target pretty quick. I mean, there's a lot of variables involved, and there's a lot of uncertainty. That's the problem. But it's a wide range. But it's not too hard to start build a model, start plugging numbers, start plugging assumptions. You can see the range is quite wide. But one thing you'll notice is that the upside is far greater than the downside once you start playing start playing with numbers. I do that a lot just to what's my upside downside ratio. I try to put in different scenarios just to see where the possible range is. So yeah, the possible range. I think this is reasonable, but things could change next day. But 2150 to 2500 seems reasonable.
Great, thank you. And we're at a little over an hour now, so I think we'll stop there. What I would encourage everyone to do again is to reach out to respective senior investment consultants in the region. I'd also encourage you to join us for the monthly newsletter or white paper or research piece that Paul Wong puts out. He does talk a lot about some technical moves and so forth in the market and gives some pure reporting on what's going on in the overall gold allocation or gold trade. So you may find that as formative as well. So thank you all for joining us today on this call. We will be reaching out to all those unanswered questions, and we look forward to working with you all going forward and helping you allocate to gold through Sprott Asset Management. So again, thank you for your time and interest today, and have a good rest of the week.